This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
Portfolio managers at PWL Capital.
Oh, shoot, I forgot. Right, yes. Portfolio managers at PWL Capital.
Jeez, you haven't made a mistake in a long time. That's the first time I think I've got a cameo appearance in the intro. So that was obviously completely unrehearsed and unprepared.
Well, it's only been the last, I don't know, five or so episodes that we've added in that portfolio managers at PWL Capital piece. So I guess it wasn't in my...
As I've said before, I get the music in my head. I know it's not playing, but the music's in my head. So I kind of know where your intro goes along with the music. So you want to kick it off, episode 148, with your latest bot.
Yeah, well, we had, I mentioned this on the podcast before, but we had a listener reach out a while ago just saying how grateful they are for the podcast content and how much it's done for them, and offered their professional skills if I was interested in having them build some bot parts. And when they made that offer, I jumped at it. I don't know if they were actually expecting me to take them up on it, but I did quickly. So I shipped off the 3D renderings of my bot weapons, and he built out of aluminum and steel. He machined this drum spinner. I don't know how well you can see that there.
Just back it up for focus. Yeah. Oh, there it is. Look at that.
Yeah. It's pretty cool. And I think we can we'll be able to play a little video on if you're watching on YouTube, so you can see what it does. But it's pretty cool.
But that bot's arch enemy doesn't stand a chance against that.
That's not true, actually. The wedge, I don't have the other bot to show you, but the defensive wedge on the other bot is actually, even though it's made out of plastic, it's thick enough and strong enough that it was able to absorb the hits from this metal weapon quite easily. I tested that, of course, as soon as it was running.
So if you want to see the bot, you're going to have to watch this on YouTube.
Yeah, or I think we'll post it on our Rational Reminder Instagram as well.
Hey, are you still buying beef from that local farmer?
Yes.
Have you seen the price of beef, and has it gone up at the wholesale level like what you're buying?
Prices have not changed as far as I know.
I tell you, we bought some at Costco this past weekend. I could not believe the prices of steak.
Really?
So just curious if it trickled down to the wholesale where you're buying yours.
I wonder what it is. I wonder what's pushing the price.
I don't know if there's demand, people not going to restaurants, therefore there's more demand for certain cuts at home for retail. I don't know. No idea.
Huh. Interesting.
Just want to update people in the merch store. So the new mug is available, the one with all the guests that were pre-2021. They're all listed properly now. So those are available for order, and they're on our merch site. Also completely restocked. Angelica loaded us up with hoodies, the blue and the charcoal. You still get free socks with every order. And we're still waiting for details on the Talking Sense cards. I know a lot of people are waiting for them, but we should get an answer soon, I'm hoping. Earlier this week, so after we recorded this, but before we released this, we had our first AMA. So hopefully people checked out Paul Merriman on the AMA this week, and we're going to have more AMAs in the future, we hope. Coming up, we have some amazing guests. So each time Ben and I are on, just us, we're going to let you know that 3 upcoming guests. So next week is Professor Robert Novi Marks. The week after, 2 weeks after that will be Professor Brad Cornell. And then 2 weeks after that will be Professor Johanna Peets. All 3 interviews were spectacular. A couple of recent reviews I want to give a shout out to. First was Mark Pitblado. And I thought his comment was, we appreciate it very much. But he said, Ben and Cameron have decided to not only share their expertise publicly, but to do so without advertisements, promotions, or subscriptions. And that is deliberate. Gel.psyd said, add these conversations to your week to expand your thinking and deepen your self-awareness. Again, very much appreciated. And Tony Smiles 11 says, just keep doing what you're doing, which we are.
Yes.
We have lots of guests lined up. We have lots of ideas. So we are going to keep this up. we love being connected to people. So as we mentioned earlier, you can check us out on Instagram. That's where Angelica puts up all kinds of different things, including Ben's bots. So that's at Rational Reminder. We're both on Twitter, easy to find. I'm on Goodreads. I love the Goodreads. There's so many good books. Unfortunately, not enough time to read them all, but it's a lot of really great sharing going on there. I'm on Peloton at CP313. We have a hashtag in that group as well, hashtag Rational Reminder, which is super fun to see people there. Anything else to add, Ben?
No, it's good. I think we can go ahead to the episode.
Okay, let's get going.
Welcome to episode 148 of the Rational Reminder podcast.
So quickly want to mention a book that was suggested to me by fellow advisor and friend Justin Castelli. The book is called Obsessed, Building a Brand People Love from Day One by Emily Hayward. So she's a co-founder and chief branding officer at a company called Red Antler, which is a branding and marketing company for startups and new ventures, and has helped build brands like Casper and Allbirds, which are two pretty good brands I would suggest to refer to. Anyways, this book really dovetails nicely with the book we mentioned 4 weeks ago called The Hidden Psychology of Social Networks, which actually got a lot of pickup in the community. I just thought this is an interesting book for anyone who has their own business or their own startup, about how consumers build a relationship with a brand unknowingly. And early in the book, the author says the most fundamental principle of building a beloved brand today is tapping into the real need for your consumers. So you have to really define, what your problem solves, and to really dig in and define the basic human problem and keep asking why. In fact, she talks at length about how in so many cases, the real, true, deep reason why someone wants your product and loves your brand is because they're going to die. I know it sounds morbid, but she says in so many cases, but you could take it for our business, for example. You talked about the value financial advice a couple of weeks ago. Like, why would you want an advisor? Well, to help build better portfolio, better planning. Well, why is that important? Well, because I want to spend more time with my family. I want to be able to focus on my health or whatever reason. Well, why do you want to do that? And you keep pushing those whys, and invariably it comes down to because I'm going to die and I want
it more. Does. It's true. I guess everything in life does.
And she also talked about technology. She said, for example, in the early 2000s, a great user experience was a meaningful competitive advantage. So Uber had an unbelievable head start, but then they had their branding problems, and then other companies such as Lyft came in and started chipping away at their market share. So she talks about how the brand is much more important than technology or a logo or a tagline. It's about this whole meaningful improvement in people's lives because they're going to die.
It's like what Dennis Mosley Williams talked about when he was on the podcast, the experience economy.
For sure. But the one great example I thought, as a side, she talks about Allbirds, which is a brand I love. And I never realized how much I love it till I looked around. I got like 6 pairs of Allbirds shoes kicking around and got some for the kids for Christmas, and they love them, and they're just phenomenal. But there's a great story behind Allbirds. The other example that she gave was Airbnb. And Airbnb took off, they believe, when they identified the true problem they were solving. They learned that instead of having Airbnb just be a way for people that own places to make more money, they realized that travelers wanted to not feel like a tourist. They wanted to experience a city as if they lived there and have like a normal kitchen and a normal place and a normal neighborhood as opposed to a glass tower downtown. And they wanted that better experience when they travel because we're all going to die. Super interesting, I thought. Anyways, great book. Highly recommend it. I loved it. It's an easy, short read. So thanks, Justin, for that recommendation. Second item I thought was neat was earlier this year, the Investment Industry Regulatory Organization of Canada, IIROC, released a rules notice regarding client-focused reforms. And one of the areas in these reforms was for better disclosure regarding conflicts of interest. So our friend Jason tweeted a notice to clients that came from a big bank. I won't mention which bank it was. I'm guessing they're probably similar for all of them. But this notice was caused by these client-focused reforms. And the title of the notice was So this was from big bank to the end consumer. Understanding conflicts of interest. And I'm quoting here, at times our interests as a financial services firm and those of our representatives may be inconsistent with your interest as our client. We've adopted policies and procedures to assist in identifying and addressing these material conflicts of interest.
I think it's important to note that conflicts of interest exist in almost any business, and disclosing them is very important. But as you read on, people are going to see why these ones are particularly, I don't know what I'd call them, egregious maybe.
Well, and this is a story that you must be aware. That is the point, to be aware of what is happening here. So if we cannot effectively address a material conflict in your best interest, or the conflict is otherwise prohibited by law, we avoid it. We inform you about the material conflicts so that you can better understand them and assess how they may impact you. Disclosure is great, right? So material conflicts may include, and this is when you get into the list, a lot of people just, I think, probably don't know a lot about this. Conflicts can come from our being a member of our bank group, which may raise a perception or risk that we favor the bank group business interests over yours. Examples of these conflicts may include investing your account in bank group investment products, or securities that our affiliate is underwriting, or securities of an issuer with whom an affiliate has a meaningful relationship. Could be service arrangements with our affiliates, including trade, routing and execution, custodial services, and introducing and carrying broker activities. Conflicts where we or affiliates earn revenue related to your investments, in addition to fees you pay us. These may include trailing commissions we earn from fund managers on investment funds in your account, spreads on fixed income trading. There's one, I guarantee you, so many people haven't got any idea what's going on there, and it's completely invisible. Foreign currency exchange fees, principal trading of securities, lending activities that are secured by your investment account, securities lending, there's another one. Conflicts arising out of competing interests among our clients, for example, allocations of new security issues, securities lending, and side-by-side management of different client accounts. This was in the letter.
Which makes sense, but we know these conflicts exist. We do, but a lot of people wouldn't. So the fact that they're disclosing them is good. I think that the existence of a lot of these comes out because the big banks tend to be vertically integrated, and they have all of the different services in house. So it makes sense that conflicts like this would arise. But for the end client, I think the question you have to ask yourself is, how likely is it that all of these things are going to work out to be in my best interest, as opposed to the financial institutions, which is of course always a big question that investors have to be asking.
Agree. Third interesting thing I picked up last week. So our friend Barry Ritholtz on Masters in Business interviewed the former CEO of Vanguard, Jack Brennan, who, by the way, just a great interview, really interesting guy. And I thought part of the conversation linked back to our discussion a couple of weeks ago, where we talked about the article in The Atlantic entitled, "Could Index Funds Be Worse Than Marxism?" And I thought, this is around minute 40 of the conversation, that Jack Brennan had a different perspective that I thought was interesting. He talked about how, with so much money in indexing, CEOs will have permanent shareholders who are more interested in strategy and not just the next quarter results. So he says, and I quote, "This gives companies more freedom to plan long-term." He says, "Promoting a myth that indexing is anti-competitive or bad for markets or is a bad investment strategy is just flawed logic and wishful thinking. There will always be plenty of market clearing activities to value a company, but the idea that a CEO can talk to a handful of permanent investors will give the best management even more confidence." Goes on to say, "Markets will be advantaged by companies being able to think in a way that today they can't, as there's so much noise in the system." I thought that was a neat perspective for someone who was a CEO of second largest asset manager on the planet.
Yeah, it is. When we have our episode with Brad Cornell coming up, he also talked about market efficiency and indexing and had some really interesting points. I won't spoil it, but even if there were no active trading, he argues that markets could still be efficient.
That's quite the teaser. Anyways, on to the main topic.
Yep. So I hope people aren't tired of hearing about happiness, but I think this is the last time in a bit that we're going to talk about it. But it's a topic that we I guess expressed our interest in this topic largely by having a lot of guests in the last 6 months or so talking about this kind of thing, and that was part of our own research. People may remember we said probably about a year ago now that we wanted to expand our horizons away from factor investing a little bit. And this is not just for the podcast, but also for the PWO Capital business and our interactions with our clients. So anyway, we identified a bunch of resources, books, papers, and otherwise, spoke with many of the authors, which is pretty cool to be able to do that, read a book and then talk to the author about it. Kind of a neat perk of having the podcast. So this is basically my expression of all of the information that we've absorbed over the last however long, 6 months or so, on the relationship between happiness and how we make financial decisions.
It's also an area that's so data rich. Lots of study has been done on this that lends itself to the way you kind of come at tackling problems, right? Which
Yeah.
I find interesting.
There's a lot of data. The data scares me, though, to be honest with you. Like there's a study from Kahneman and Deaton from maybe 2010 that showed that, and we talked about this. We've talked about this study on the podcast, and it's also in some of the other books that I read on this topic. But they show that experienced happiness stops increasing after a certain point of income. In that study, it was $75,000. But reflective happiness in that study kept increasing. And we talked about this in the Mayer Statman paper, I believe, that we talked about on the podcast a while ago. They talked about that same data point where your reflective happiness may continue increasing with increasing wealth. And that has, a lot of important implications for financial planning and financial decision making. In a more recent paper, I think this one was a 2018 paper, if I remember correctly, they looked at a bigger sample, they looked at a global sample, and they had better quality data. And they actually found that was no longer true. I'm getting way ahead of myself. This is like in the middle of my notes, but it's just on the topic of the reliability of the data in this field. It makes me a little bit nervous. Like the way that we talk about having to take financial data with a grain of salt, because it is still, economics is still a social science. It feels even more so like that with this data, but still interesting insights. And one of the books that I used to familiarize myself with this topic, and I reference it in what we're about to talk about, is The Happiness Hypothesis, which I've mentioned before, by Jonathan Haidt. And he looks at the more modern positive psychology data, but he also draws from ancient philosophy like Buddhism and Stoicism and Chinese philosophy, and kind of compares what does modern science say, what does the ancient stuff say, and what are the differences. So that gives some pretty interesting insight too, because there is a ton of overlap, but there are also some marginal differences. Anyway, so we'll jump into this topic. So I've called this Investing in Happiness.
Catchy.
One of the things actually that made me really finally sit down and write this, because I've been thinking about it for a while, is there was a massive discussion in the rational minder community that's still going on, and I'm so far behind now. I would feel like a foreigner if I go in there at this point.
You will, my gosh.
But there's this huge discussion on the optimal mix of factors and the optimal amounts of diversification versus concentration. And I mean, it's this massive, I think it was, last time I looked, it was over 300 hours of reading time to read the whole thing. I can't even imagine what it would be now. Yeah, just a huge, or maybe it's 300 minutes. Maybe that would make more sense. Yeah, 300 minutes. 300 hours is CFA preparation time. Yeah, so tons of material, but it's all about the optimal, well, basically what is the optimal portfolio? What is the optimal mix between different types of financial products and different factor exposures and all that kind of stuff. And that's interesting that there's so much discussion about that, because I think that type of behavior where you're looking for optimizations that are going to result in more money. And I think it's the same when you're looking for the next big win, like investing in Bitcoin a few years ago, all that kind of stuff. Or even working really hard at a job that you maybe don't like that much to get to the next promotion. All of those behaviors are physiologically addictive. And that sounds like an extreme statement, but there's a 2001 paper that used fMRI to measure brain activity under different circumstances. That's by Hans Breiter and some co-authors, including Daniel Kahneman. And they found that obtaining more money activates the same regions of the brain as illicit drugs, which sounds crazy. But that's what they found. Now, when you hear that for money, I think that the common perception is, maybe being addicted to having more money is not so bad. More money doesn't hurt. But I think that the problem is that for our brains, that experience of getting more is always relative. Having a lot of money doesn't satisfy the desire for more money. And there's lots of research that shows this. Even very wealthy people, when they're asked in a survey, how much more money would they need to feel happy? In many cases, it's like twice as much as they currently have. There's a study that it was in Ashley Willen's book, where the survey asked people with $10 million or more how much more money they would need to be happy. And I think it was 75% of the people responding to the survey said that they would need at least 5 or 10 more million to be perfectly happy with the amount of with the amount of wealth that they have. So knowing that getting more money and getting more basis points from your portfolio is truly addictive in the same way that that drugs can be. I think it's this question of enough versus wanting more, which we talked about with Morgan Housel and Brian Portnoy as well. But figuring out that enough piece is obviously critically important, at least when you think of it. But I think it requires taking that big step back and asking, what is the objective? And what I'm going to argue in this discussion is that the objective is living a happy life. Loaded statement there. So we're going to try and pick apart what are the contents of a happy life, and what is its relationship with money. And when you think downstream, which I'll talk about in a minute, there can be some pretty significant implications on financial planning when you shift the thinking.
Mm-hmm.
And we've talked, like I've made offhand comments about how this might change financial planning in past episodes, but hopefully this is a tighter delivery of the whole thing. But money has this unique ability to move economic value through time. You obviously work today, make money, and you can use that to store a value. One of the things that money is to fund spending in the future. Time and money are both finite resources, and every day we make allocation decisions. How are we going to use our money? How are we going to use our time? And those decisions absolutely interact with each other. And in many cases, they're traded off against each other. I don't think that there is an objectively optimal way to allocate time and money, just like I don't think there's an objectively optimal way to build a portfolio. Same kind of idea. But I think that if we anchor those allocation decisions in the objective of living a happy life, it can help. Mm-hmm. It can help make those decisions more beneficial from that perspective of leading a happy life. So we have to figure out where does happiness actually come from. A large part of it, and this is such an interesting data point, but a large part of relative happiness, like if you take a group of people, and this is done, I think, with twin studies, but a large portion of happiness is heritable. And when I was reading about this stuff, there's been criticism about assigning percentages to these things because, like, the data quality issues that we talked about earlier, or reliability issues, I don't know. But the most notable piece of research on this seems to suggest that it's about 50%. I've seen between 30 and 50% of relative happiness is determined by your heritable set point.
Wow.
You can't really change it. Yeah. So there's the biological set point is a big piece. And then Martin Seligman suggested this equation. So he called it happiness equals your biological set point plus your circumstances plus the factors under your voluntary control. So biological set point is a huge piece. Circumstances, small. Again, from the same source that gives the 50% for heritable, they say 10% for circumstances. 10% of happiness is determined by your circumstances. And then the remaining 40% is determined by your voluntary activities. Basically what you do with your time and money. So that 40% is where we as people making financial decisions can hopefully exert some influence on living a happy life. The 10%, the circumstances being so low or relatively low, I think is a huge point for people to understand. That I know I first read that in Happiness Hypothesis, and to me that kind of blew me away. It's one of those things where I look back on it now and try to remember, did I really think that circumstances would change happiness before that? And I guess I did, because when I read it, it was like, wow, I couldn't believe it.
Well, that's about humans are so adaptive to their situation, correct?
It's largely about adaptability for sure. But it's just crazy to think that your where you live, your health, your age, education, intelligence, gender, race, all of these things have relatively small impacts on happiness. But if you think about when someone sits down to make a financial plan, I mean, where you live is a big one.
Mm-hmm.
People want to move to a warmer part of the country or a bigger house or close to a lake or whatever. And that can become a very big financial decision. But based on the research, that there seems to be some level of consensus about your circumstances don't actually matter a whole lot. So that to me is pretty profound. So the voluntary activities, which, like I said before, is how you choose to allocate your time, money, that is the big piece that we can exert some control over, and it has a big impact on happiness. Now, like you said, Cameron, circumstances don't seem to matter that much, probably because we adapt quickly to changes in circumstances. If we move to a bigger house, that just becomes normal very quickly. If you move close to a lake, that becomes normal very quickly. Moving close to a lake is an interesting one because there's also research suggesting that time in nature is important for happiness and also changes perception of time. Anyway, I didn't dig too much into that research for this, and it's probably just confirmation bias because I'm moving close to nature.
You'll be happier this summer.
But there is real published literature suggesting that being close to nature increases happiness and slows down the speed of perceived time. Now, this is another one from Happiness Hypothesis that I found just fascinating on circumstances. So we're saying circumstances don't really matter because we adapt quickly, but Jonathan Haidt gives he gives 4 examples, but I'm going to talk about 3 of them. Noise, so variable or intermittent noise, interferes with concentration and increases stress, and we do not adapt to that. So living in a city close to a busy intersection, not a good idea for happiness. So that's a circumstance that we can relatively easily change, or at least factor into decision making. They can have a big impact. Commuting, only in heavy traffic though. Commuting in a nice, easy, relaxing drive doesn't seem to be an issue, but commuting in heavy traffic increases stress, and it's, again, not something that we adapt to. And then the other big one is feeling like you're in control. If people don't feel like they're in control, they are not happy. That's maybe a harder one to change in some cases.
I agree with all three.
Yeah. Now, to talk about happiness, we have to define the two types. So there's experienced happiness, which is best described as good feelings, feeling good, pleasure, and reflective happiness, which is best described as a deeper sense of fulfillment or being your best self. Good feelings like pleasure and comfort is referred to as hedonia. So like eating chocolate, petting a soft bunny, that's hedonic. People have heard hedonic pleasure.
Petting a soft bunny? Where'd you get that?
It was in one of the books I read, and I thought it was actually pretty good. It does feel nice to pet a soft bunny. Okay. And I mean, if you want to offer some other examples of hedonic pleasure, be my guest. But those are the ones that I thought were tame enough to use. And then hedonia contrasts with eudaimonia, which was first described by Aristotle and is best translated as flourishing. So hedonia, the good feelings and pleasure, that's pretty easy to think about. I kind of think you know it when you feel it. But eudaimonia takes more reflection and deeper thought. One way to measure eudaimonia, which we talked about on the podcast a while ago, is using the Cantril ladder. So you imagine a ladder, and this is in a lot of these studies, this is how they measure reflective happiness. So you imagine a ladder with 10 steps numbered from 0 to 10. The top step represents the best possible life for you, and the bottom step is the worst. And you have to ask yourself, on which step of the ladder do you feel you are standing on? So eudaimonia is more about living well, living a good life, while hedonia is more about feeling good, feeling like actual physical feelings of pleasure or enjoyment. Now, one of the things that came out of Martin Seligman, he's the guy that kind of founded the positive psychology body of literature that's since exploded. He came out after his initial hypothesis. He kind of changed the direction of positive psychology, and instead said, if we shouldn't be thinking about happiness, we should be thinking about well-being. And well-being basically just encompasses, at least this is my interpretation, encompasses both types of happiness, experienced happiness and reflective happiness. And the way that Seligman captured that, and we've talked about this on the podcast before as well, the way that he captured that is with a 5-factor model. I hope people like that, because we know we like factor models around here. So he has the Perma Model: positive emotion, which is the feeling good piece; engagement, which is finding flow or being absorbed in activities; strong, healthy relationships, and that's one that all throughout this literature is a common theme. Strong, healthy relationships being extremely important; meaning, which is having a sense of purpose beyond yourself; and accomplishment, which is setting and achieving valued goals. And there's a fascinating piece about goals, which I'll talk more about later. But basically, there's this thing called the progress principle. We get good feelings from making progress toward a goal, and we also get good feelings from achieving a goal. But when you achieve a goal, it's over. You get the good feeling, and then that's it, and it's done. But on the way there, taking the steps toward the goal, you get a lot more enjoyment than you do by actually achieving it. It's called the progress principle. So setting and achieving valued goals, it's almost more about the process of getting there.
Similar for travel, right? The anticipation of the trip is often as much fun as the actual trip.
For sure. And this comes up in material purchases versus paying for experiences as well.
Mm-hmm.
That same idea of anticipation seems to be stronger for experience than it does for things. So the Perma Model highlights the idea that a happy life is more than experiencing pleasant feelings. But I think this this is where it gets really interesting in terms of psychology. And this is something where, like I mentioned, my concerns with the type of data that we're working with earlier, this piece seems to be less problematic. The system 1 and system 2 thinking. So with having looking for both experienced and reflective happiness, knowing that is required for overall well-being, the challenge introduced by our 2-speed brains, so that's the Kahneman thinking fast and slow, system 1 and system 2, where people may know this, but I'll talk about it anyway for people that don't. System 1 is the automatic, quick thinking, little or no effort to engage voluntary control system that's sort of responding to your environment throughout the day. Most of your decisions, I think it's like 98%. I hope I'm not overstating that. I can't remember the actual number. The vast majority of the decisions we make every day are carried out by system 1. And then system 2 allocates attention to the effortful mental activities that demand it, including complex computations. But we have to actively engage system 2. It's not on all the time because it's more, it demands more resources. So our bodies have been designed to keep running on system 1 as much as possible and engage system 2 when it is necessary, which one of the things I read, I can't remember where, might have been happiness hypothesis. It's actually, it can be physically uncomfortable to engage system 2.
Oh, for sure.
Because our bodies are averse to using the extra energy. In happiness hypothesis, Haidt uses the metaphor of an elephant, system 1, and a rider on top of the elephant, system 2. So the elephant responds to its surroundings, acts on animalistic instinct, including wanting to impress others and rise in the social ranks, like some real, ancient evolutionary stuff. And the rider on the elephant can think into the future, plan, learn, but it does not have at any time full control over the elephant, because if the instincts are strong enough, the elephant's going to do what it wants to do.
It's a great metaphor.
Right. I think it's pretty good. I said that, I explained that metaphor to my wife once because we were talking about one of our kids was doing something, I don't know, and I explained the elephant and the rider, and she was like, "Did you just think of that?" No, I wish.
Yes, dear.
So the elephant wants to, and then this is where it ties back into the overall well-being. The elephant wants to seek pleasure and avoid pain, climb the social ranks, but in many cases that can be in conflict with the other factors in the Perma Model, with the other aspects of well-being. For that, we have to engage the rider, who, like we just talked about, can be uncomfortable to turn on. The elephant wants the kind of pleasure that comes from, eating good food or getting a massage or petting a soft bunny, or winning big on a stock pick, or not wanting to miss out on seeing somebody else winning on a big stock pick. But the actions that satisfy the elephant can often be in conflict with flourishing. And I think that the challenge is that in many cases, people day to day making financial decisions, and not even realizing it probably, end up letting the elephant make the decision. Because it's hard to sit back and reflect. It's easy to, gamble or act on impulse or do what feels right in the moment. But that's where it leads to the conflict with the overall model of well-being. So this is where that relationship between, we've got the 2-speed brains, the elephant and the rider, we've got the 5-factor understanding of well-being, and we can use that information to help us make decisions about how we use our time and money. And this is where, the topic we did recently in the CSI video on what is good financial advice, I kind of alluded to this, that a big part of advice should be being able to offer feedback and context on a lot of this stuff, because most people, I don't think, if you just think about sitting down and setting goals. If you tell somebody to sit down and set, what are your financial priorities? In many cases, it's, I want a bigger house, or I don't want to work, or I want a cottage. And in a lot of cases, the goals that people will think they should have will be at odds with this model of well-being that we're talking about. So yeah, I think letting the system one brain, the elephant, determine financial priorities can result in maybe short-term experienced happiness. With stock picking and stuff, it's a little more questionable because you're more likely to lose than win. But maybe just the act of gambling feels good. I don't know. I didn't look into that too much. But those short-term experienced happiness episodes come at the expense, in most cases, of sustained reflective happiness.
Mm-hmm.
So we trade our time for money at work, which is fine. People need to work. Well, I mean, they don't always need to work, but work is important psychologically as well as economically. But working more to make more money or to get a promotion or whatever is not always an obvious trade-off. And I think this is another, we talked about this at the beginning when I got ahead of myself. But this is that 2018 paper that I mentioned, happiness, income, satiation, and turning points around the world. That's by Jeb, Tay, Diener, and Oishi. And they had a global representative sample of over 1.7 million people. And they found that the income satiation point for experienced happiness, so that's hedonic pleasure, is $60,000 globally and $65,000 in North America. So above $65,000 per year of income per individual, people did not experience more happiness day to day. And that's a point that I think a lot of people are familiar with. That's the one that's been thrown around a lot. Experienced unhappiness, this is a really interesting one. Experienced unhappiness stops decreasing at about $75,000 globally and $95,000 in North America. So people making more than $95,000 per year in North America, their feelings of sadness stop decreasing at higher levels of income. Or unhappy feelings stop decreasing. And then reflective happiness, which is the big one that until not long ago, like maybe until 4 days ago when I read this paper in detail, I thought there wasn't a cap, that you could keep having more reflective happiness with more money or with more income. Not the case, at least in this sample. For this one, they found in North America, the satiation point for income on reflective happiness was $105,000 per year.
So interesting.
Right. So above that level of income, people no longer evaluated their lives more positively.
This gets back to your discussion of base rates that you talked about 2 weeks ago and in your video. At least have the awareness around these base rates that you can start framing the decision as a rider instead of the elephant.
Exactly. Exactly. And the base rates are critical to the elephant. Otherwise, you can't do all the planning and thinking.
Yeah.
Now, one of the other really interesting insights from this paper is that in not all regions, but in some regions, including the North America region that they looked at subsamples for, there's actually a turning point, only for life evaluation. But there's a turning point where above, and I couldn't actually find the dollar amount. Maybe I just didn't look hard enough in the paper, but there was a turning point where above a certain level of income, life evaluation, reflective happiness started to decrease. So not only does it plateau, it actually starts to decrease. And the authors speculate that it could be because high incomes are typically accompanied by high demands on time, which can also limit opportunities for positive experiences like leisure activities. So that's an interesting one. Not only does happiness or life evaluation stop increase, it can actually turn around with higher levels of income. But it may not be the income, it may be what goes along with it. Money can increase positive emotion, like we talked about. It can decrease negative emotion, and it can increase positive life evaluation, but in all cases, there's a satiation point. I think that's really, really important. Understanding money's role in well-being. So we talked about the Perma Model. We've talked about the fact that there's a cap on how happy money can make you. But I think it's worth thinking through the Perma Model and the relationship that money has to the different elements. So it's a necessity to meet basic needs, obviously, and that's where that $60,000 threshold is believed to be. Above that level, you've kind of met your basic needs. So necessity to meet basic needs, reduce stress, probably pay for positive experiences, like maybe going on taking some time off and that kind of thing. So that's all important for positive emotion. Money allows us to invest in skills, hobbies, and other activities that drive engagement. Money affords shared experiences, memberships in clubs and things like that, and the time needed to build and maintain relationships. So that's the relationships piece. It frees up time to be involved in things greater than the self, like family, politics, work, community, social causes, volunteering. And money can fund the path to achievement and mastery in sports, hobbies, and work. So there's definitely a role that money has to play. I think the mistake that people get caught in is focusing on money rather than on what money affords. I do think that within the sample of the people in the Rational Minder community, which I know is a relatively small subsample of overall listeners, and maybe it's influenced by the discussions we've had in the community, but a lot of this stuff seems to be appreciated by the people in there, which is reassuring. Maybe I'm preaching to the choir to an extent. In her book Time Smart, from Ashley Willens, who is obviously a guest on the podcast and a listener favorite. That was such a good episode. She explains that people who value time more than money are likely to be happier, make more frequent social connections, have a stronger relationship with their spouse, which is another important thing for happiness, and be more satisfied with their job. And she also claims, makes a supported claim, argues that valuing time over money is also pro-social. When we feel that we have more time, we're better able to serve other people, which in turn increases our own happiness. And one of the problems with this is that she argues that we're living in a time poverty epidemic. People who are time poor are less happy, less productive, more stressed out. And this is where it comes back to money. Some of the biggest causes of time poverty relate directly back to money. People incorrectly believe that earning more money today will allow them to be happy in the future, and they tend to undervalue their time. So instead of trading time for money, which is what most people I think do, working less and trading money for time by outsourcing unpleasant tasks can increase happiness. So time influence, important aspect of a happy life. Also, though, what you do with your time is important. So active leisure activities like volunteering, socializing, and exercising, directly related to happiness. Flow, the state of immersion in a task that is both challenging and aligned with your abilities. That's a state that some research has suggested that flow is valued more highly than feelings of pleasure.
Wow.
Which is pretty interesting. So being in that state of flow you can't be in a state of flow all the time. But that is one of the times when people are happiest. And if you ask somebody, I can't remember which book, I've got like 4 different books on positive psychology open here. If you ask somebody who's in a state of flow what they're thinking about, they'll say nothing, which is all just another just interesting aspect of flow. Now, unless you're into driving race cars or something, which is one of the things that can lead to a state of flow. I think the activities that tend to result in persistent happiness, like all those things that I just mentioned, they're not big, expensive trips or material purchases. So I think it's kind of safe to say that the best things in life, or the things that make people happy, are often free, or they don't cost very much, and they're definitely not luxury goods, or at least they don't have to be.
That I couldn't agree more with.
Yeah.
Completely, emphatically agree, at least for me.
Yeah. Well, for me too. Again, maybe this is all just confirmation bias. Like I'd way rather go. I actually can't stand big trips, like traveling and the whole big orchestrated trip and the hotel and I can't stand it. Whenever my wife and I talk about traveling, I say like we need to at least explore all of Ontario before we start traveling.
I enjoy a good trip. I would say that, but I get extreme pleasure out of sitting here in the morning and reading for a couple hours. Like that costs whatever a downloadable book costs.
Yeah. Now, this doesn't mean that all spending is bad. Like we just talked about a bunch of the things that you can do that don't cost a lot of money that are directly related to happiness. There's a paper with a very provocative title, 2010 paper, If Money Doesn't Make You Happy, Then You Probably Aren't Spending It Right, by Dunn, Gilbert, and Wilson. And they explain that one of the biggest problems is our inability to make accurate, effective forecasts. And in this paper, they offer a bunch of ways that people can be better at spending to align spending more with happiness. But the effective forecasting piece is big. People are often wrong about what will increase their happiness in the future and for how long that happiness will last. Some of the ways to overcome that: spending on experiences is more impactful to happiness than spending on things. And this one's almost like feels cliche at this point. I think everybody's kind of heard this one, but we're saying it again. People are happiest when they're engaged in what they're doing, and experience can provide that engagement, that state of flow, depending on the experience, obviously. Reflecting on past experiences enhances mood more than reflecting on past material purchases. And people tend to anticipate and remember experiences more than things. That's that anticipation piece that we were talking about earlier. It's harder to adapt to experiences than to things, since each experience is unique while things are static. That one I thought was pretty interesting. They gave the example in the paper, I think, or maybe I'm paraphrasing the example, but anyway, if you do your kitchen, if you renovate your kitchen, it's going to be the same kitchen every day. You're going to adapt to it. If instead you pay for a weekly or monthly cooking class, each time for a year, each time that you go, it's going to be a unique experience, which makes it much harder to adapt to. And then the other big one, and it comes back to that relationships piece, is that experiences are more likely to be shared with other people, and strong relationships are one of the most important pieces of living a happy life. And the point here that I think is interesting, though, is that as much as we can say it's better to spend on experiences than things, I can't help but wonder if it's just better to do experiences that don't cost money. Like I'd much rather go for a walk in the forest than pay for some other experience. Maybe a cooking class with my wife would be a worthwhile experience. I don't know. Mm-hmm. Another way to deal with the adaptation issue, and this one is so intuitive when you think about it, but if you buy frequent small pleasures rather than fewer large ones, you're much less likely to adapt to it. So doing things like dining out, going for coffee, getting a pedicure, getting a massage, doing those things more frequently rather than buying a very expensive car, much more likely to lead to happiness. Your happiness per dollar should be much higher doing those frequent small pleasures rather than one big thing. And again, it comes back to adaptation. And then another big one is pro-social spending. Spending on other people, and this comes up everywhere in this literature. Spending on other people makes you happy, makes people happy.
So it could be gifts, could be charity.
Yep. Any pro-social spending that benefits other people. We're hardwired to want more money and nicer things. And this is, again, that evolutionary stuff where we want to climb the social ladder because that's how we survive. But adaptation very quickly leads to a desire for even more. Once we have more, we just want more. Happiness tends to stop increasing at moderate to high, but not unattainable levels of income. Like 105,000 was the cap for reflective happiness. That's a high income. I don't want to sound out of touch, but it's not a crazy high income. And so somewhere between 60,000 and above, but up to 105,000, happiness stops increasing. Valuing time over money, engaging in active leisure activities, finding flow, building and maintaining strong relationships, spending money on experiences rather than things, spending money on other people, and indulging in frequent small pleasures rather than fewer big ones are all principles that can lead to happiness. And interestingly, a lot of them don't really cost money, or they cost less money than what people might do otherwise. In Geometry of Wealth, Brian Portnoy summarizes what matters to humans as the 4 C's: connection, the need to belong; control, the need to direct one's own destiny; competence, the need to be good at something worthwhile; and context, the need for a purpose outside oneself. Money plays a role in underwriting a life with all of those things, with connection, control, competence, and context. But money itself is not the objective. And there's that trap of thinking once you have more money, you can figure all this stuff out. But that's just not how it tends to play out. Now, here's where the kind of rubber hits the road, is that designing a happy life based on all the stuff that we just talked about probably looks a lot different from what a lot of people would design if they just sat down without having any of this context and tried to figure out what their financial objectives are. I think that traditional idea of sitting down and setting your financial goals based on some projected retirement date and this rosy vision for the future, which people tend to have, it's an inherently flawed process, because we have this weak ability to forecast what will make us happy in the future, and we have a tendency to adapt to whatever circumstances we're in, whether they're good or bad. If they're worse than we expected, it might feel bad for a little bit, but you adapt. If they're better than expected,
Exactly.
you feel right.
Exactly.
Yeah. Now the other piece, and I mentioned this earlier because I always get ahead of myself, is the progress principle. We get pleasure from making progress toward a goal and from achieving the goal, but while progress toward the goal offers continued pleasure along the way, post-goal pleasure is short-lived. So another way to describe that is, when it comes to pursuing goals, it's more about the journey than the destination. And that, again, when you think of financial goal setting, the idea, and I know not everybody does this, but just as an example, someone decides they want a really big house, so they're going to make a bunch of sacrifices and maybe feel not super happy for a period of time while they save up for the down payment. That's not enjoying the journey for a destination that probably won't actually make you as happy as you expected. Now, the other crazy to think about aspect that makes long-term goal setting really challenging is this thing called the end of history illusion. And this was documented by Coidbach, Gilbert, and Wilson in a paper in a study that they did. So people tend to believe that they have recently become, at any point in time, if you talk to somebody, they'll believe that they have recently become the person that they're going to be for the rest of their lives. It's crazy when you think about it, though. It makes sense. Like, I reflected on myself, and you think that you are you, but in reality, people change. People change over time. So people may believe that who they are today is pretty much who they're going to be tomorrow, but in reality, that's not likely to be the case. And people do tend to change over time. So this is what they documented in their study. That the reality is people do tend to change over time, but people don't believe that they will change in the future, despite the fact that they have changed to that point. So the end of history illusion is this idea that we don't think that we're going to change, but you probably will, which makes that effective forecasting an even bigger issue. So I think one of the ways to address all of these issues is by inverting the goal setting process. Instead of setting goals, try setting anti-goals. Instead of thinking about the future life that you really want to have, just think about what are the things in your life that you don't want to have now and in the future. Instead of looking far into the future, it's like the example of the big house. Instead of looking far into the future and making sacrifices today to achieve some future life that in reality you may not like as much as you expected, it might be more sensible to design the life that you want today by finding ways to remove your least favorite parts and make the journey more pleasurable, since it's hard to know what life you'll actually want and be happy with in the future. And I think the practical implications here could be things like scaling back an aggressive savings goal to instead pay for maybe a house cleaner or a meal delivery service, if those are things that you don't like doing. Taking a lower paying but more enjoyable job that results in daily states of flow. Donating to local charities and volunteering instead of going on fancy vacations. Sticking to a sensible diversified investment strategy with a low dispersion of outcomes and a reasonable expected return instead of trying to hit the lottery with individual stock picks. I mean, that's a real practical implication. You don't need to win the lottery once you've designed the life that you're happy living.
You're setting up the bad advice for the week perfectly.
Now, a couple last points. Eliminating work, and this is when you think about this, when you think about what does someone do when they sit down to make a financial plan, generally speaking, eliminating work is typically the focus. Like you're planning for financial independence, which is still important because we talked about earlier, I mentioned briefly, and maybe it deserves more emphasis, that control or feeling like you're in control is one of the most important components of circumstances that makes people feel good. Lacking control makes people feel really bad. Financial independence, I think there's a pretty strong argument that it does increase control, or that it can increase control. But I still think that the idea of eliminating work is flawed, or at least making that the primary objective of financial planning. It's definitely a point to plan, to factor into a plan, but making it the centerpiece, I don't know if it makes sense. In the happiness hypothesis, Haidt argues that love and work are the two most important ingredients for human happiness. And this is a quote from the book. Love and work are crucial for human happiness because when done well, they draw us out of ourselves and into connection with people and projects beyond ourselves. In the book, there's a whole chapter on finding meaningful work and work that aligns with your strengths. But I do think that the idea of eliminating work rather than finding work that meets those criteria could be a flawed component of many financial planning exercises. And the last piece is that none of this is static. And we mentioned this when we talked about the financial advice too. It's not, you don't just do this once and forget about it. Like we mentioned, people, personalities, values, preferences, people generally change over time. And so the pursuit of happiness, like any other goal, is more about the journey than the destination. And there's a good chance that there will have to be many recalibrations along the way to keep things set up in a way that makes the person that you are at that time happy. That's it.
Oh, that was great.
I hope so. I hope people aren't tired of hearing about happiness. I don't think I have any more to say about this.
No, yeah, that was good. It dug in a lot of corners, and it puts it all in one nice, tight package. It was great.
Cool. So this will be a
video
CSI video. Yeah, at some point in the next few weeks. And then I'm shifting to inflation hedging. Back to
your happy place. All right, so I'll give your voice a break, and I'll pick a card here. So we'll do the Talking Sense from the University of Chicago Financial Education Initiative. So these are cards, whole deck of cards. So I picked two. First one, when your goal is to save, how do you avoid the temptation of spending money? So I've never really been a huge saver. So I don't really have temptation, and Lisa and I are in complete alignment, and now the kids are both in alignment on this as well. So we actually don't spend a ton. I don't honestly enjoy it as much as I used to. Maybe I'm changing. You mentioned change earlier, but I don't find myself tempted to spend money on stuff. And maybe it's affected by the pandemic and being at home, but I just don't get as charged out of it as I used to. Simple as that. How about you?
Can you say the question again?
When your goal is to save, how do you avoid the temptation of spending money? You're not a big spender either, though.
No. I don't know. I don't know if I have any good tricks or anything, but I've tried budgeting in the past. Not really a fan. I do put money into buckets. Like I'll put money into an account designated for something, and I won't spend that. So instead of budgeting, I guess I just allocate what I need for stuff, and then if there's excess, I can use that for discretionary spending. But like you say, I'm not a big spender. I save pretty aggressively just by default. So I unfortunately don't have any good tips.
Here's a long one. An investment involves doing something today with the expectation that it will pay off for you in the future. Investments can involve things like money, time, or work. What is an investment you have made that has paid off for you? An investment involves doing something today with the expectation that it will pay off for you in the future. Investments can involve things like money, time, or work. What is an investment you have made that has paid off for you?
Well, a lot of my time has been dedicated over the last 7 years to my job at PWL, and I think that's worked out okay. And maybe even to drill down further into that, I think doing this podcast and the Common Sense Investing YouTube videos, that's been a pretty significant time commitment over the last, whatever it is, 3 years that we've been doing that stuff. And I think that's paying off. What about you?
Yeah, I mean, I'll link it back to work as well. Over time, we've invested in ourselves, our people, in new people, and developing the team. And the focus has always been on the quality of the work, not about the return. But if you focus on the right people and the right environment, it does pay off for everybody. So that's the example I can think of.
Maybe we think too much about work. My family's going great too. I spend lots of time with them.
So there's our 2 cards of the week. So on to the bad advice of the week, which came from Donald. And as always, if you send us bad advice ideas and we use it, we'll send you off one of these snappy Rational Reminder hoodies. So he shared a YouTube video for this week's bad advice. And the video was called Why Buffett, Cuban, and Munger All Hate Diversification, the World's Greatest Investors. So it's from a YouTube site called Intelligent Money Investing. And the host's name is Trace. And I must honestly say, and I watched the video 4 or 5 times, I don't know what the point of the video is, as he never really says it. But I guess he's basically saying that diversification is not a great idea. But he doesn't actually say it. He lets the guest clip say it. And then the pinned comment down below links to Robinhood. So I presume there must be some sort of rev share with Robinhood referrals or something. Anyways, this is a video from January 27, 2019, and it's a discussion about diversification and why, Buffett, Cuban, and Munger hate it. Anyway, so Trey starts the video out with Mark Cuban's opinion of diversification. So we're going to play that little short clip now from an interview he had with the Wall Street Journal.
Yeah, all that asset management, diversification, that's for idiots. Diversification, that's for idiots. Vacation, that's for idiots. Idiots.
Okay, Ben, so now we know that diversification is for idiots, which is good for us to know. And as we always say, if you believe that, you're basically saying that you're smarter than the rest of the markets, which is one heck of a big statement to make. So then Trace goes on to say and show that in his Robinhood account, he's very well diversified with my 30 holdings. But then he shows a screenshot of his holdings, and his total account is worth $8,200, with most holdings being a single share. So I would say no big deal, except the video has had 1 million downloads, and there's 2,300 comments underneath it.
Unreal.
It's completely unreal. So then he goes on to include a response at a Berkshire Hathaway annual general meeting where Warren Buffett was asked for his views on diversification. So listen to what he had to say.
So there's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, you know, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own.
And then, of course, Warren Buffett turns to Charlie Munger for his opinion on all of this.
Much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But you know, I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate, and you know, there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I get ordinarily classified dementia, you know, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
And then, to bring it all home, we go back to Mark Cuban in that interview with the Wall Street Journal.
And so what are you investing in? What are the areas that you feel you know?
What I did in 2008 and 2009, I put everything into MLPs and MREITs, mortgage-backed securities, ones that I thought were the better companies, and I just piled in. And I also piled into Australian bonds because I thought the economy was good next to China. It was my way of playing China.
So you make one-way bets. This isn't portfolio balancing you're talking about.
No, all that asset management, you know, diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing.
It's kind of funny to listen to this now, especially the Berkshire Hathaway annual meeting was just this past weekend, where, and Buffett has said this many times over the years, but he reiterated it again last weekend, saying that most people will fare better by owning an S&P index fund instead of betting against individual stocks. He said that many of the novice investors who jumped into the market recently drove up the value of video game stock, you know, GameStop that we've talked about, are essentially gambling. And he said that the stock trading platforms that allow people to buy and sell stocks like on Robinhood for free are only encouraging this gambling. You know, if you're Warren Buffett and you can analyze a company and hold it for decades, then go ahead and build a concentrated portfolio. But as we said many times, you know, diversification is your friend. There's no need to be concentrated. There's way too much risk. If you go back to what you said about happiness, from a happiness perspective, you don't need to feed the beast. You don't need to feed the elephant on this.
I did a video a while ago on, I called it Advice from Warren Buffett, I think was the title. But I talked about stuff that Buffett has said, like in his letters about indexing, and one of the things that I don't remember the numbers, but it was like he said something like he's known 10 people that he's confident could beat the market. Like he's met 10 people in his life that he's confident that could beat the market. And then meanwhile, people use Buffett as the example for why you should try and beat the market. It's just it's the most obvious example of the overconfidence bias that you could ever imagine.
Right, that's what's going on here. So we're only commenting on exactly that. Here's a YouTuber who's pulling selected clips from different AGMs from Berkshire Hathaway, Mark Cuban, wrapping it up and loosely saying this is what you should do without actually saying this is what you should do other than the title of the video. But 1 million followers and all those comments, it's just incredible to me.
The clips aren't wrong. Like, they're not wrong. If you want a small chance and massive gains, then yes, diversification is the worst thing that you can do. Stocks are like, it's like lotteries. There's massive skewness. You're more likely to lose than win, but there's a small chance with a very concentrated portfolio. that you win enormously. And you don't get that with diversification. So that the statements aren't wrong, but to take that and use it as advice for the average investor trading in their Robinhood account, hoping to save for a happy life, that is crazy to me.
It's a great sum up. Anything else for today's episode?
Nope, I think that's it.
Beautiful. As always, thanks for listening.